This video will explain the new option strategy that I had implemented. Due to some personal reasons, I can no longer day trade, so I um, been researching and reading concerning options and decided to go with this specific strategy. Been working on it for 3 months now, and I've been trading it live, and I've done some testing, and I wanted to post a video concerning this strategy. Basically, it's not mine. It's something that I saw on YouTube from a trader that been doing it for. It's a hedge fund that's been doing it for several years, and she's been very successful at it. So decided to copy it. And basically, what she does is she looks at 50 to 56 days out and sells strangle short strangles. Sell both a call and a put. And I know at the surface it seems to be quite risky because the risk can be unlimited, but not if you monitor the position. Again, I cannot day trade, but I still can view the markets during the day, and I do have alerts on my cell phone and so on and so forth. So this is you can still do this while working a full-time job. And the basic idea is basically I look at exactly about as much as 56 days as possible out, and I sell a put that is that has a 95% out of the money probability of OTM right here, and I look for 95%, which is and which is, let's see, somewhere between 15 17 cent. And again, this is collecting premium. I'm selling those options. I'm doing this for the IWM, but it can be done for the SPY or the Qs. And this is a paper trading account, so it doesn't really matter, but you can go somewhere between 1 and 10, and you can even do more than 10 contracts each time. So again, I'm selling the put at a 95% out of the money probability, and I am buying the call with, this one does not have it, but approximately 90% out of the money. So for example, I would be selling most probably the 9 cent premium, or 82, which is 60 cent premium, but that's 82% out of the money probability, which is a bit risky. So it will be something in here, most probably 96%. I have done a lot of back testing on this, and this is basically live back testing through ThinkBack with Thinkorswim. This is a Thinkorswim platform that TD Ameritrade offers for free, but I do have a live account with them, and this is what I've used to test this method over the years. And I have done some videos in advance that I will go ahead and explain. And I picked out 2 years, one for 2011 and one for 2008, to show the strategy in a volatile market, as well as not so volatile market as we had in 2011. So in 2011, again, this is working with IWM, and ThinkBack allows you to go back in time, and they'll give you the prices for over 20 plus years, and look for, started with January, look for 56 days, but at this stage I only had 53 days, so I took that, and I'm looking at a 5% in the money probability, or 95% out of the money, and that is right over here at 14 cent. I sell that one, and with a call 90% out of the money, and those are sold for 15 cent and 29 cent, 10 contracts each, and I'll move forward in time. I will move this video forward in order to reduce the time that it took to do this test. And again, this is selling January 2010, and I moved forward in time to 56 days out for February 2010. The same thing, looking for 95% out of the money, and that's at 13 cent. And again, it's 87.91, somewhere in between. It's not an exact science really. Somewhere in between you want to be. You want to be as 90 as possible. So I only took the 20 cent premium, sold the 20 cent 70 call for February. And as you move forward on this date, it shows you the profit and loss, and it shows you basically the first one here in January 2010. As I move forward in time, that it was expired worthless, so you get to keep the whole premium, and keep moving forward. And again, I'm collecting. As you see right over here, you'll notice that sometimes the market does move, and one of your calls or puts that you had sold will get in trouble, and you will be losing money. So the idea is, once a call or a put goes down to a 70% out of the money probability, from 95 on a put to 70, or from 90 to 70, I exit the position. There are different thoughts about this, and some authors suggest you can make adjustments and you can buy a call or roll them out, or so on and so forth. But what I do in my case, I basically exit the position. I take my loss. At the same time, so for example, in this call, if I had had to exit, buy back this call, I would go ahead and sell some more puts at 95% out of the money to make up the loss, because there'll be a loss in here. Now, what will happen is, once I put the buyback on think back, and it will not show it. I'll just have to buy a position with the same strike, the same month, to offset this loss in here. Somehow I can't just close a position and think back and show it as realized loss or gain. I have to buy another one. So what I did is keep going in time, looking for when this position became 70% out of the money, and it's not here. I'm still looking for the date on when. And usually, you can move this think back day by day to see what the out of the money probabilities are, but that would take hours to finish this video. So I'm moving in weeks at a time and a few days at a time, and I'm again looking for March to see if when March is at 70%, so I can take the loss at that date. Once I find the date, I'll change it in here as well. Okay, and again, that was the call for 67, and the date was 320. Let me find the date. . sometimes it takes some time to find out exactly when the option is at 70% out of the money. Okay, so now actually what I went ahead, I did not see the loss was never at 70% out of the money, and that's why I continued with April. I went ahead and sold April as well. Let me make sure, see exactly what happened. Yeah, right over here. So now on 326, the call, the 74 call, no, yeah, the April position never really became 7% out of the money. There was just a small loss on it, and it was realized. Uh, but the May is the one that got in problem. We are $2,000 in here at one time, and I'm going back in time to find out exactly when we are at 7% in order to buy the callback, the 69 callback, and that was I'm moving this forward to reduce the time. Looking for the April call, and that is the 69, and it's still a 94, so right over here 65. I'm moving only one day at a time now, a few days at a time. '69 is at 57. Right over here 65. And it's 68 right over here. So on March 15th, the call that I had sold for $69, 69 strike, is a 68% out of the money probability, and that's pretty much when I exit the position. And again, in think back, instead of exiting, I just buy one, and it shows both, and they'll offset each other. They won't be 100% offset. There'll be a loss realized, but I will calculate all of those numbers at the end. So I'm going to move forward now, and at the same time, when that happens, I went ahead and sold a few more puts on the other side, on the of this strangle, on the 57 for April, to offset some of the losses that I had in this call. And I'm going to fast forward now. This video is taking too long already. And as you see, there's a loss of this loss is realized, and it was taken, and it was not adjusted because we never really got into the 70%. It had jumped. This we had 1,300, but we have a call in here with a gain of and I'm moving forward again of 1,602. So the difference between the 1622 and the 2252 is the loss that I have in this position. So yes, there will be some losses, but as long as you exit the position at 70% out of the money, they are minimized, and you're still making money, some money to offset on selling the puts. So I'm moving forward now. I'm going to cover a whole year, and I'm going in 53 days, 50 to 56 days out. I am selling calls and puts, the naked positions. And of course everything here is what's premium that has been collected from those options. And I'm passing forward now, going in, covering the whole year. And we're almost finished with a year. And this is December, so this is all the profit and losses that I had for the whole year with that strategy. And now I'm going to go ahead and show a same strategy for 2008. And basically because we had a lot of volatility in 2008, I wanted to show that this strategy has worked over. I've tested this over 10 years so far, and it has been profitable. And again, this is just a paper money account that I'm just making the test. And I'm going to push forward again. This is the same thing, starting off with January of 2008 as in strike month. Same thing, I'm selling the 58, and I'm selling the 58 put, and I'm selling the 55 call for premium. And I'm just going to move this forward. Same thing, premium is being collected, and most of those options are expiring worthless. And the strategy does get in trouble here as well, and I wanted to show that if and when that happens, you exit, you buy back the call or the put, and you buy or you sell calls or puts on the other end of the strangle. And that's right over here. As if you go back, you notice that this is when the strategy has gone in problems. So when I noticed that, I deleted, went back in time, think back time. So over here we have a loss of $7,540. But again, the idea is not to let it go down this far, is to watch for a market correction, crash slash move up of several hundred points in one day, and we obviously had that in 2011. And I'm going back in time to see when the October put was at 70% out of the money probability, and once I see that, I immediately buy it back and take my loss. But in think back, it's going to show it as a long position, and you just I'll have to offset the prices to show the loss that has been realized. And leave on 10-1. Let's see. I'm still looking for the time when we are at 70% out of the money. Okay, so we did find it. So around the October 2nd, we are at 7%, and I buy back the 60 put, and at the same time I sell more calls, out of the money calls, at 90% out of the money, to offset some of the loss that will be realized in here. Yeah, this is the gain from the call, from the put that was bought back. So basically the difference between this and this position is the loss that I've taken, which is approximately 900, but there's about $800 in gains of put that was sold. I'm sorry, calls that were sold at that same time to get the position to break even. So I'm gonna go forward some more, and basically that's pretty much it. I mean, it continues on, and it does pretty much what it did in 2011 video that I've done. Same thing. There's an issue here, and I'm looking for the time when we were 70%, so I can either exit this put, not either, to exit this put and sell some more calls. But sometimes we never quite get to the 70%, and the market corrects and everything's back. Actually, this one I did buy it back right over here, and I bought back and I sold two more calls to offset that. And that, you can see right over here, we had a loss of 6,310, and the call, we bought it back at 5,335. That's about a loss of 1,000. But those two calls that I sold on that same month realized about 625 each. So basically the bottom line is, here's a spreadsheet of both years, and this is 2011, based on 10 contracts. That's the total gains from IWM for 10 contracts 2011, and it depends on which broker you deal with. You might have to have a $10,000 account or $20,000 account in order to and some even more, again depending on which broker you're with, to hold 10 contracts to sell 10 contracts of each, and gain those numbers. And for 2008, even with the $7,000 loss that was closed out, I would ended up the year for 6610. I'll do some more videos for few other years, and maybe a few other instruments such as the SPY and the Qs to show, and I will you can post those live trades, but with the trade taking 2 months to materialize, it's just really not a good idea. And that's my option strategy, and wish you well.